inventory is an asset. Okay, this is the stuff that we sell to people. So under a perpetual system, when we purchase something, here they're purchasing it for cash. All we do is we debit inventory and credit cash. Okay. If we were in a periodic system, we would debit an account called purchases and credit cash. And like I told you in my mom's store, what we would do is we would say, here's what we had at the beginning, plus all our purchases during the year. That's how we did it. So two different ways of doing it. All right. If we so now let's just shift. I'll try to quit talking about both, and instead we'll just talk about from a perpetual system. If we purchase on account, we debit inventory, and we credit accounts payable. Okay, so pretty easy. All inventory is an asset. It's stuff that's available to sell. Okay. Now this makes it seem like we just have one big inventory account. If you think about someone like Walmart, every SKU, you know what a SKU is? I forget what it stands for, SKU, barcode, okay, is unique. Now, not every barcode is unique in the sense that every product's barcode is unique. So every can of this brand of peas will have the same barcode. So I don't know how many SKUs there are, unique barcodes in a Walmart store, but I would guess thousands, right? So there's a subsidiary ledger, I mentioned that term before, in inventory for each one of those SKUs, because they have to track each one individually. Hard to do if you were doing it with a handbook. Easy to do for computers, right? That's again another way that technology's changed accounting. It does a lot of the heavy lifting. But for our purposes, just know that when we purchase inventory, we're going to debit inventory, and then we'll either credit cash if we pay cash, or credit accounts payable if we didn't pay cash, if we're going to pay later. Okay. All right. So recognize that when we purchase stuff, a lot of times suppliers will give us discounts. So one of the hard things about this chapter is for each of these transactions, think about it, any retail store could in one setting be a purchaser buying something from a supplier, and in another setting be a seller selling something to a customer. So you have to understand what role you're fulfilling to make the correct journal entry. Am I the purchaser of this transaction, or am I the seller in this transaction? And that's something I think a lot of students struggle with until they get used to it. So you just have to say, what role is the business in this transaction? So when you're a purchaser and your supplier offers you a discount, there's certain ways we record it. Okay, so first I want to kind of show you, this is how terms are expressed. So this, it'll say, so what will happen is someone will sell you something and they'll say, I'm going to sell it to you under these terms. And they would call this 210 net 30. That's what they would call this right here. 2/10 N/30. What that means is I will give you a 2% discount if you pay within 10 days. Or if you don't pay within 10 days, then you owe me the net or whole amount within 30 days. Those are your choices. So if I sell it to you, you can pay me 98% of the cost of it within 10 days. We'll consider that paid in full, or 100% of the cost from 11 days on to 30 days. You'll see 310 net 30. Sometimes you'll see like a 25. Sometimes you'll see just a net 30 or a net 60, which means the whole amount's due within 60 days. So just become familiar with what this little annotation means. This is about discounts, okay? Again, so this is kind of like, I'm willing to let you pay me in 30 days, but I want to incentivize you to pay me quicker. So I'll give you a little discount to do that. It's pretty normal in business to do that. All right. So here we go. Assume that Net Solutions places an order from Alpha Technologies on January 5th with terms of 210 net 30, a 2% discount within 10 days, or the whole amount due within 30. In order to pay the invoice on January 15th, the last day of the discount period, Net Solutions borrows $2,940, which is $3,000 minus the discount. If an annual interest rate of 6% and a 360-day year is assumed, the interest on the loan for $2,940 for the remaining 20 days. The credit period is $9.80. I don't know why they're doing all this. So in essence, we would actually come out ahead to borrow it. But here's what I want to get to. So the net savings to Net Solutions for taking the discount is computed as follows. Discount, $60, interest for 20 days at $9.80. So for them, it was worth it to take it. don't get too wound up in this. Other than a lot of times in accounting, we have to make financial decisions about what's the best deal. $50 for some people would be like, it's not worth all of the trouble of borrowing it from one person to pay it off, so I'm not going to do it. But I'll give you an example of a business I worked with who was a construction business that grew from 7 employees to about 100 employees in a 4-month period. And they found if they would, they were buying about, they had a constant accounts payable of about $1 million. And so they would be paying some of it off, but then building other projects. So it was constant. And so if they could save 2% or 3% on their accounts payable, what's 3% of $1 million? $30,000. So that would be a $30,000 a year savings if they would just make sure they paid within the discount period, right? Like that's enough to fund a couple of part-time workers, right? Or maybe one part-time worker, depending on how much your wages are. So this starts to matter when you're a big enough business. You know, I don't know what Walmart's accounts payable is. It's got to be insane at any given moment. We could actually pull it up on Yahoo Finance and look at it. So terms of the purchase are normally indicated on the invoice or bill that a seller sends a buyer. Also, this book, we're going to see this start coming up, they use what's called a 360-day year convention. What that means is there's 2 different ways, and I don't know why these books are still doing this. So in the olden days, back before my day, back before computers, okay, it was easiest to just, for math, assume that every month had 30 days and there were 12 months a year. So there was 360 days a year. That just made doing the computations a lot easier when you're doing it by hand. Most businesses today, because they have computers doing the work and they think I could get 5 more days of interest out of somebody in a year, are using a 365-day convention. So to add confusion to us, now we have to understand, wait, is this a 360-day year or is this a 365-day year? We know that all days have, all years have more than 360 days. So anyway, so just recognize that they're using 360 days. So there's a little formula that when we learn about interest rates that we'll need to know, which is if you're paying interest on something, to calculate the amount of interest you're going to pay is the principal, which is the amount owed, times the rate, which is the interest rate, times time. This will come up a bunch in the near future. Principal times rate times time, that's how you calculate interest, okay? Where principal is the amount owed, the rate is the interest rate, and time is time expressed in years, because the rate is always expressed as an annual rate. So you'll see that as we get into it more. So if we take the discount, this is what it would look like. Our inventory would go up by its cost, $2,940, and our accounts payable to Alpha Technology would go up. Okay, it's a liability, so it increases with a credit. Then when we actually paid it on the 15th, our accounts payable liability will go down with a debit, and our cash will go down. It's a pretty standard transaction for a purchase, okay? Let's say we somehow, if an institution did not pay within the discount period, inventory would be debited for the amount of the mixed discount. So let's say we intended to take the discount and then we didn't pay till February 4th. They would debit 2,940, accounts payable, debit inventory, and credit cash. So the reason we would have to do that is, remember when we made the original transaction, we recorded it this way, inventory going up, accounts payable going up. We were gonna pay this much on the 15th, but for whatever reason, we decided we couldn't. This does happen, where you intend to take the discount and then you don't get it paid in time. So now you have to pay the full amount. You'd have to show your cash going down by 3,000 and your accounts payable going down by 2,940. So what's the difference? Well, it's that $60 extra of discount you didn't take. we need to charge that to inventory, so the inventory reflects fully what we paid for it, okay? So that's a little confusing, but once you work through, and again, I feel like these concepts seem a little confusing, but once you get working with them, they're not too bad, okay? Like this chapter, I think people, they don't hate as much as they hate as adjusting entries, so it's doable. All right, we also have purchase returns and allowances, right? Sometimes we will return things to our suppliers and say it's defective or it's not what we ordered or whatever. And so all we do when we return things to the supplier is we debit our accounts payable and credit our inventory. So it's just the reverse of purchasing it, okay? If we've already paid cash, then they would send us a cash discount, right? And we report it that way with cash. So May 24th, we returned $1,000 of the inventory purchased on May 2nd. May 12th, paid for the purchases on May 2nd, less the return discount. So there's our original purchase. Inventory went up by $4,900. Accounts payable went up by $4,900. Then we had a return. So our accounts payable goes down with a debit, and our inventory goes down with a credit. Then when we pay it, we only pay the amount that we still owe. Okay. Again, once you do a couple of them, you'd be like, that makes perfect sense. Why would you pay money you didn't owe, right?